Welcome to SBI's GTM Value Creation Corner podcast with SBI CEO Mike Hoffman hosting. In this episode, Mike is joined by Tom Ryan, co-founder and CEO of ICR, to discuss the importance of effective communication for publicly traded companies. Their conversation highlights the necessity for CEOs to adeptly convey their messages to the street, manage their reputation, and mitigate risks in a fast-paced and highly scrutinized market.
Welcome to the show. Good to have you.
Thanks so much, Mike.
Thank you for sure.
Having me.
So, Tom, I always like everybody to get to know our guests a little bit. So can you talk a little bit about yourself, your background, ICR, and why companies hire you?
Yeah. Well, grew up in the Northeast, went to a small college in New England, got my MBA at Vanderbilt. I then, had always been interested in the stock market. I had a series of jobs with different investment banks, and over that 10-year period, got a really good sense of how investment banks work, banking, sales and trading and research, how it all interlocks together. And in my role as a sell-side analyst, companies would come in and, maybe they're going to go public or, want me to get on board with an investment banking transaction or write a positive research report, and hopefully the stock goes up and everybody does well. But during that period, companies would come into New York with their PowerPoint and kind of tell me their story, and they would have someone sitting next to them who had more of a PR background and didn't really understand the art of the stock market, how to be economic to an investment bank, didn't understand my job. And I thought, if anybody should be advising a CEO on how to communicate to the outside world, particularly of a public company, it should be somebody like me, because I get the whole value creation strategy and how to do that. And so based on that, we started ICR in 1998. The idea took off right away. And believe it or not, we're 26 years later. We get hired by companies who want to raise their visibility and kind of manage their reputation and risk in the market. And so when companies report their quarterly earnings, we tend to write everything that the management team says. We take them through the paces on Q&A. What are you going to ask? What are you going to get asked? How do you talk about the future? How do you set guidance? We do that with investors. We help companies navigate the media. And, traditional corp comms like internal, external, and we do a lot around transactions like IPOs and convertible bond issuance and stuff like that, helping manage the communications through that and the advisory to maximize the value of those transactions.
Yeah, this is great. So if you are the CEO of a publicly traded company, if you are the CEO of a PE-backed company that's thinking about an IPO, if you are a PE deal team with a portfolio company that you're thinking of taking public, this is a podcast you're gonna want to hear. You're gonna want to hear from Tom, because he's done this over and over again, him and his team, for companies. So let me ask this. So it's always interesting when you listen to an earnings call, and then there's this question that's asked that seems like it's way out there. Like, wow, that's a pretty sophisticated question, and the CFOs and the CEOs, they seem to have the answers at hand. And I'm assuming that's some of your work behind the scenes that does a good job prepping the CEOs and the CFOs for those questions.
Yeah, we're kind of uniquely qualified to do that prep work because ICR is organized by industry, by service and by industry. And kind of what I mean by that is our head of technology might work with 100 software companies. And so when a management team, let's say, however the calendar falls, 50 software companies have already reported and they're number 51. We've gathered and analyzed all the questions that are being asked, all the macro trends. But, my guy who runs the technology group, he was a sell-side equity analyst in the software business forever. He knows all the KPIs. He knows everything about the industry. He knows what kind of move stocks one way or the other. And so he'll know all the relevant macro topics and then topics relevant to the company and their own situation. So it's like taking a portfolio manager and analyst, taking them over the wall like they're working for you as a CEO. And it's critically important for reputation purposes and credibility, which is really what it's all about as a public management team or a company that aspires to go public.
Yeah, it's fascinating for me the level of preparation that goes into this. So let's back up at a higher level. We at SBI we advise companies on growth strategy, the ultimate, how do you execute on a go-to-market operating model, and then what are all the pieces from a talent standpoint that go into that. So there are certain expectations that that the investors will have in a publicly traded company, and I always wonder how important is the broad story versus the execution against that. And I'll give an example. I hear CEOs, and this is a real example, and I won't name the company, but they'll say, our product migration journey is going to be 10 years long, and here's what we're going to do. We're going to do this, and these timeframes. And then as a PE-backed CEO, I think to myself, 10 years, that's like 3 sponsors. Yeah. That's 2.5 turns.
Yeah. Might as well.
Right, exactly. So how important is the story versus the execution, if that makes sense?
It does make sense. When you're a public company, a lot of the kiss of death as a public company management team is having like a promotional CEO. Someone who, and I've had this many times in my career where the CEO would say to me, well, I'm treating shareholders like they're customers. And that is actually not the right strategy, because customers want, a tremendous amount of value. They want this, they want that. As a public company, managing future expectations is the most critical thing in driving valuation and the success of your career. And so what I mean by that is, your group, Mike, you go in there, you're probably, in cahoots with the financial model, and what could this mean if if you execute at a high level, what does this mean for sales over the next 5 years? That's like an internal discussion. That's not anything you're going to share with the outside world. Let's say that your analysis spits out, hey, we're going to grow, 20% for the next 4 or 5 years, which is, would be like phenomenal. What I would do, depending on where the stock is trading, if it's kind of at a low valuation, probably when you get hired, it implies that companies are either refining their approach or their approach might be broken. They might be at a transition point where they need to reinvent how they go to market. Anyway, let's say the stock is down because of that. They've had a few hiccups. If you're at a low multiple, you have a lot more freedom to talk about the future and admit, that things aren't great. And so how I would articulate that, if the internal number is 20% growth every year, I'd say, look, we think we can grow between 10 and 15% over the next 5 years. Some years we might be above that range. Some years we might be below that range. But overall, we feel very comfortable there. That way, when a portfolio manager looks at the company and they run the numbers, they're going to look at that 10 to 15% and they're going to say, you know what? Like, I buy into that. That's achievable. What you've done there is you've de-risked the stock, because the last thing you want to do is publicly state 20% or more, which some promotional CEOs would do. The stock price goes up on that immediately, but now there's so much risk, because if you're handicapping whether they can hit that 20 every year, like maybe they can, maybe they can't, but they know they can hit the 10 to 15. And when there's no risk of future expectations, that's when you drive a sustainable multiple of the stock.
It's interesting because there's one, and you and I have talked about this, and again, I'll leave the name of the company out, but it's a publicly traded company, and it was interesting to listen to their earnings call, because they said low teens ARR growth. And I know internally they're driving for mid-teens.
Yeah.
Like that is what they're telling the team. Yeah. And so when I came back and said, so you've moved it to, we've got to move this thing to low teens. They're like, no. That's what we're telling the street. We're saying internally we need to move it to mid-teens. So that's the expectation
100%.
setting that you're talking about.
And that's exactly what I was talking about. Very smart to do it that way. And a lot of times people don't like to use numbers. They'll say like double digits or mid-teens. It gives you wiggle room, right? Because mid-teen to me could be, I don't know, does mid-teen to you, Mike, mean 14, 15, 16? Does it mean 13, 14, 15, 16, 17% growth? I don't know, but there's a little wiggle room in there for management if they kind of...
I could be convinced that 12 is mid-teens, like 12 to 17, I guess.
Yeah. Yeah.
So let's shift over to the difference between, we started off with private equity and publicly traded companies in different timelines. So if you're a CEO in a PE-backed company, what should you be thinking about with the deal to your private equity deal team and you yourself and your team as you barrel toward that outcome?
Yeah, great question. I have seen situations in my career, everybody's kind of pulling on the same rope after the initial investment, whatever needs to be done to grow the company. When you get to, a year before maybe you're aspire to go public, sometimes the private equity firm, they'll meet with bankers and things like that. That's a whole other story about how to handle that. But a lot of times I've seen cases where the private equity sponsor pushes for the highest valuation on pricing. And what that does is it sets management up for failure in my mind because the expectations are too high. In other words, the financial model that's shared with the bankers is aggressive, right? And maybe they're saying, hey, listen, we want this valuation and here are numbers that support that. So let's say they get a really high valuation on pricing and financial performance goes a little bit sideways. When you have a super high valuation, there's no margin for error. You have to hit those numbers. And so what can happen is, what was good for that initial transaction and people put a lot of money in the bank. Now the company is set up with numbers that have been shared with the outside world that are super aggressive, that they have a decent chance of missing. All credibility is lost, reputation is ruined, and you're probably boxed out of any kind of secondary or raising more capital or having other liquidity events. So it's kind of slow and steady wins the race. I think you have to come to a financial model with your sponsors that, where you can have kind of a beat and raise model where you just start to build credibility, certainly for the first 4 quarters out of the box or preferably the first.
Got it. So it's more of a steady as opposed to a big bang, because we've seen some companies come out of the gate pretty hot on IPO and then
and they miss their first quarter out of the box and they're dead, and that's just not where you want to be as a public management team. And I would even make it personal. I would say to a CEO, look, you want your run here to be incredible. You want to have an amazing reputation and credibility with investors and all the other stakeholders, because you know what? You can't do it forever. You probably want to be a board member. You want to be involved and maybe consulting, do other things down the road. People are going to look at this track record. That's why it's so important.
And for public companies, so I'll shift back to public for a minute. What percent would you say have a PR firm like yours that are not on contract?
That's hard to know. I think that if you're let's say you're a private equity backed company that's going public, and let's say your pro forma market cap is going to be like $1 billion. If you're between like $1 billion in market cap and 15 or 20 billion in market cap, you have some semblance of a team internal. The smaller you are on that scale, the fewer resources you have internally. We not only come with a, vast array of knowledge by sector and all the Wall Street expertise and managing the media and all that, but we also have bodies, like you might have 5 people on your team doing a lot of the logistics or administrative stuff that needs to be done too. So I would say companies in that zone are open to using firms like us. I mean, look, we have like 900 clients, and there's what, 5 or 6,000 listed companies. Could Microsoft use our help? I think they could, but they have an army of people internally. But we could probably help them on different projects, things like that.
How should, and this goes a little bit to the reporting, so this is curiosity on my part, and being PE backed, I tell my investors everything, right? You have the same thing, right? They know every detail and this whole dashboard of KPIs. How does that change at a public level, and what kind of KPIs and guidance should you set? Like, at what level should you think about that?
Yeah. I'll tell you a really kind of what I think is a really interesting observation on that private and then going public. When you're private and you have a PE sponsor, there's no question who controls the board, right? And they are very hands-on is a word for it. When you get to be a public company, there could be, your sponsor may remain on the board, but the board is kind of more built out, right? And is chosen by the CEO. And maybe there's a trip to the Bahamas to have a board meeting, and this is great. So it's almost like it's less like strict or intense almost as a public company. And I'm not speaking for every public company, but sometimes you'll see a public company and look at the board members and you're kind of like, this seems like a cocktail party board member. People who want to stay relevant and they're 70 or whatever, not there's anything wrong with that. But it's just interesting how that changes. Anyway, as you get to be public, the Fidelity and T. Rowe and all the big investment funds, they're going to hold you to KPIs that are similar to when you're private, but you're just probably revealing less information to the public markets. You're not going to have a list of 20 different things because you're just going to get caught up in the math in anything that you do. I think in most industries, let's go back to technology or healthcare or restaurants or something like that, there's probably 3 or 4 or 5 things, whether it's, margin or growth rates on revenue or same store sales if it was a restaurant company, that you're going to be held to. But I wouldn't go out there with like 10 or 12 KPIs. It's like a nightmare to manage the analysts when they're trying to model all this stuff because you just get trapped in the math. And I don't think.
Yeah, it was interesting. I read one actually yesterday. It was, it's a relatively new entrant to NASDAQ and interim CEO. And they had so many KPIs that they were tracking that the analysts were focusing on the KPIs that weren't there versus the really important ones, which were like they hit the number both on the top line and the bottom line and continued to have momentum in growing the business. But they started focusing on these little KPIs on the mid-market and the small end of the market. And how come you didn't hit those KPIs? And it was just sort of interesting to watch it unfold.
Goes back to my comment about some companies trying to treat shareholders as customers, thinking like, hey, they want all this information from us. Let's give them everything. And that's just not the right strategy because it just complicates your life unnecessarily. You got to run the business, right? When you become a public company, now management has a whole other 10 or 20% of their time that they have to allocate to dealing with shareholders. And you want to keep it simple, keep it conservative, and that's when you have more time to run the business versus tons of KPIs, super high valuation, promising too much. And now you've got, what does that do? That attracts short sellers. It attracts maybe an activist. And like now you have all kinds of things tugging on your time to try and mop that up. Slow and steady wins the race. Take less of a valuation initially and build it over time and build your reputation and credibility. And that's where you come out with the best outcome.
So that's good advice. So on the KPI side, less is more. Focus on the most important ones so you reveal less. So the other side of that is in every company, bad things happen. Now, in a PE-backed private company, if there's a cyber attack, you can kind of keep that a secret and you don't have to tell anybody. If it's a publicly traded company, that has to be revealed. So how do you handle things from a PR perspective, like a cyber attack, like a high-profile EEOC claim, things of that nature?
Yeah. I think when you become a public company, most management teams and boards are very like myopic. It's like it's their situation and everything that happens is a huge deal. And I'm not saying it's not. I think my point with that is like the portfolio manager of Fidelity sees companies missing numbers, having issues, having crisis situations all the time. And they understand that things aren't linear and they're not perfect and so like you have to figure it out. How you deal with it, I think every company that goes public should have a formal crisis plan written and ready to go. And at even a very basic level, it just has the name and contacts of everyone who needs to be in the room if the what hits the fan, right? It's all your lawyers and the senior team, and they could be all over the world, like who knows? Just at a basic level. But then how you handle a crisis like that, a lot of times, when I was an analyst years and years ago, I used to get like press releases in the mail. That's insane. That's how old I am. But now like information comes out of companies instantaneously, even when like you don't mean it to happen, right? And it lightning, like at lightning speed, it's on the internet and through the echo chamber, and all of a sudden management is like stunned, like they got clubbed on a fishing boat or something. So if a crisis happens and you don't have all the information, you've got to articulate the process you're going through to get that information, right? So a lot of times people will have a press conference or they'll put out an announcement. These are the facts. This is what we know. This is the process we're going through. We're bringing in, the former head of cybersecurity at whatever company to kind of consult with us. Here is the process that we're going through to kind of get to all of the facts, the ones that we don't know. And you know what? We'll be back to you in 24 hours. And as a public company, I think you'll know whether whatever crisis hits will be a very material hit to your future earnings or not. And you can kind of probably make a commentary around that, like, hey, we don't see this as material, or, this could affect, our guidance in the future, but we'll be back to you, like in the next 24 hours with an update or something.
So this goes all the way back to one of my first questions, which was how important is your articulation of the story? So even in crisis mode, I'm sure you've seen situations where initially, in a crisis, initially the stock takes a hit, but the articulation of the story and the action items behind it gives confidence so that there's a bounce back that actually helps the stock in the long term. Is that?
Yeah. Words matter, as people say. You have to be extremely precise with how you communicate that. The best outcome, and I've seen it happen, we were involved with a crisis situation with Lululemon, and I won't go into the exact issue, but it's something that kind of blew up in the press. And Jim Cramer and David Faber on CNBC, as this was happening, their focus was on how the company articulated and handled the issue. So they said something to the effect like, you know what, they're really handling this the right way. We'll get more information in the future. So they weren't even talking about the thing that happened. They were talking about how well the company handled it. And that's what you have to do. It goes back to what I opened with: credibility, reputation. All of those things are extremely important as a public company.
Yep. Yeah, that is. So, again, it goes full circle back to how important is how you handle it and how you articulate that publicly.
And yeah, and I would just really quickly say, it's not just your shareholders and the media, it's your employees. They're sitting there like, hey, what does this mean to me? What does this mean to us? your business partners, everyone along the way that deals with the company. So it's really like it's coming up with what you're going to say, but then integrating it with all those different stakeholders.
Okay, last question, and I'm asking this because it's top of mind. We have been doing a lot of work on kind of digging into go-to-market and the effectiveness and efficiency of go-to-market organizations, publicly traded company go-to-market teams, and contracted by activist investors. So it happens that they'll come to us. So any advice or any thoughts on handling activist investors as a CEO?
Yeah, I have a lot of thoughts there. I think the best defense is a good offense. Be conservative in what you promise to the outside world in terms of financial performance, and build great relationships with your top 20 shareholders. Because if they understand the plan, they think it's conservative, they believe it will drive value and valuation, they'll be on board with you. Be a smart allocator of capital. That's really, I think that a lot of activists will kind of cloak themselves in the governance stuff. But at the end of the day, like, they want the stock to go up and they want companies to allocate capital properly. And, if you're, let's say that you have a company, you haven't really invested in it for a long time. Years and years ago, like Mattel was in this situation. They had a big dividend. The board felt like if we reduce the dividend, like the bottom's going to fall out of the stock, yet they needed to invest in the business. And, like a dividend to me says, we don't have anything to do with the money, so we're going to give it back to you as a shareholder. But they actually needed the money. And so it was a lopsided approach to capital allocation, and it happens quite frequently. And so you have to get back to like a balanced approach. But again, the best way to avoid an activist is properly allocate capital, be a great communicator with your shareholder base, make sure they understand the plan, and make sure that it's a plan that creates value. Because look, at the end of the day, I think most public company management teams are going to be judged by the stock price, period.
So, all right, so this is good, but it's inspiring. I know I said that was the last question. This one, it may or may not make the cut, but
It's all right.
But I do have a question. There's a lot of times you hear about this focus. So with capital allocation, down that thread, you hear this maniacal focus in some cases, which is good, on free cash flow. Is there a point at which you get penalized for that? Like, hey, why aren't you taking some of this that you're doing and reinvesting it in the business to grow this thing more?
Yeah, a lot of times you'll see companies where their CapEx is like, in order to get like a really good growth rate, like you can only execute so much in 1 year, but they'll have like a huge amount of free cash flow, but they just can't even spend it. Like, even if they wanted to. That's where, I think you want this balanced approach, which is maybe like Apple. They make so much money, they can never reinvest all of it and everything. So what do? They pay a dividend and they raise it conservatively every year, and they buy back shares. And they also use some of that free cash flow to invest in organic growth. Organic growth is the number one driver of valuation. You can't financially engineer your way to an increased value without like growing your earnings per share. So companies where their cash flow is really high and they don't need all of it, they have a really balanced approach over the long term. They might be using it to pay down debt, some other stuff. So it's just that approach, I think, that really resonates with professional investors in the public markets.
Very helpful. So actually, we are going to keep this in because what you just said on organic growth is the biggest driver of equity value. What a great advertisement for SBI. That's all we do.
I know. I was going to say that's a good one. Yeah, and it's true.
It's why we're in the business we're in. Is so if you're trying to figure out how to use free cash flow to drive growth, we might be able to help. Tom, this has been great. It's been really helpful. I think there are plenty of CEOs that are listeners to the podcast that could use your help. We'll make sure that contact information, everything's available if anyone would like to reach out to Tom and to ICR for some help. But I appreciate your time.
Thanks for having me, Mike. Always enjoyable to catch up.
Sure. All right. Thank you.
You've been listening to SBI's GTM Value Creation Corner podcast with CEO Mike Hoffman hosting. Visit SBIgrowth.com to read SBI's latest research, join upcoming events, or learn about SBI's GTM services. Don't forget to subscribe to this podcast and connect with us on LinkedIn.